We are finishing up with the last two elements of the fraud exposure rectangle. This is from chapter 11. This is the last video, video 3. So we've talked about management and directors and how they expose a company to fraud. We've talked about relationships with outside the company can expose them to fraud. And now we're going to talk about the organization and the industry can expose a company to fraud. So if you're looking to see if a company has fraud in the financial statements, they're going to build an organizational structure that makes it easy to hide the fraud. They'll have an accounting department that's not very good. They'll have a lot of complex companies, you know, like all these related offshoots where they can funnel money through in other countries. They'll have, you know, parts of their entity will be in a tax haven like the Cayman Islands, something like that. A group of individuals controls these separate entities. They've got a lot of acquisitions. They take on a lot of new debt and do a lot of things through these other companies. The board has a lot of insiders on it, so that's how it's organized to get away with stuff. The audit committee doesn't answer to the board. They answer to, I mean, the internal auditors don't answer to the audit committee. They answer to the CFO or something. They'll set the organization up so that it won't be, the auditors won't be independent, so that the accounting people won't question. They'll hire a lot of new people who don't know much. They'll be constantly turning over their controller, because that person will say, hey, I don't want to do this, so there's things you can look at in the organization. Also, it's very different from the industry itself, right? So if it's in an industry where all the organizations do one thing and this one's doing something else, that could be an indicator of fraud. Also, it's a very highly competitive industry. That could be an indicator of fraud just because it's hard to keep up. If it's very competitive, very low margins, there's a big competitor that has a lot of weight around and you're a little person, the little person's gonna need to commit fraud to keep up, right? So you got to look at the industry and compare the organization to the industry. That will tell you something. Now, what we have to look at, maybe fraud examiners are going to have some more, but what all of us on the outside have to look at are the financial results themselves. So you can learn a lot by looking at the management and the relationships and the kind of organization it is, but you can also ask questions about the actual financial statements themselves. All right, so these last 4 slides are some things you can look at. Any of us can do this and compare the financial statements using these questions, and it will tell me this seems like there's fraud here, or there could be. I guess it's like there's the risk for some potential fraud. All right, so are changes realistic, right? So that's why we do those horizontal analyses across time, that time series data, right? Is this stuff changing in a way I would expect, right? Are these balances realistic given the nature, age, and size of the company? Do the actual physical assets exist, right? They list here, we got these assets. Can I see them? Has there been significant changes, right? So again, we're doing the analysis, the ratio analysis, and is there a big change from one year to the next or one period to the next? Are there a few large transactions accounting for a significant portion of a balance, right? So if you're committing fraud and you're doing some kind of one big lump transaction to make sales look better, that would be a good indicator. Are significant transactions made near the end of the period, right? So what happens is, especially when they're trying to meet analyst expectations or meet some kind of earnings goal to get their bonuses, they'll come to the last week of the month or the last week of the period and like, oh my goodness, we're gonna meet what we need to make. So then they'll do like a big transaction. So you look at the end of the month for big transactions. Does everything appear so consistent that it's not even realistic? Um, are you looking at everything's this way in first quarter, second quarter, third quarter, then fourth quarter, all of a sudden there's a big transaction, right? Because your year end, you're trying to make your year end goals. Is something unrealistic in some other period, right? Every period is about this, but this one has something weird, right? Do they not have cash flows? That's, why the financial people say cash is king. You go to the cash flow statement. If you have quality earnings, right? In other words, your revenues minus your expenses equals net income, and that's not messed with, right? You haven't done something weird with allowances or depreciation. You should be generating cash, right? So, is that true? When you go to your cash flow statement, is the cash from operations or is it from investing and financing, right? So where's the cash coming from? That's a great indicator. Is there pressure to get capital, right? Or is there something going on that we need to raise funds, right? We're going to have a stock issuing. Is there some pressure that would make it seem like are we at our debt threshold? Are we going to need a cash infusion? Or does it look like we're going to need something? That might cause them to create fraud, right? We're not very liquid. Might create fraud. Is there a lot of estimates, right? Remember, some assets have depreciation. Well, all assets, I guess, have depreciation, but some assets are intangible. Does it make sense to you that this patent is worth this much? Right? So there are some assets that have characteristics that are based on estimates, like cash flows. All right. So cash flows are based on an estimated revenue stream and a discount rate that you've selected, right? So does that stuff seem reasonable? Do the cash flows seem reasonable? Do the discounts rates seem even reasonable? If you're doing a discounted cash flow, just a small change in an interest rate is going to make a huge change in the ultimate fair value. All right, so is growth rapid compared to other companies in the same industry? Your company should probably make about what other companies make in the industry, right? Now, they may be bigger company or smaller company, but ratio-wise, they should look pretty similar. Growth-wise, they should look pretty similar, unless there's something to explain it. They have some fantastic new product that everybody wants, something like that. Is it highly vulnerable to changes in interest rates? So if your company is highly leveraged, in other words, they have a lot of money they've borrowed, a lot of bonds, a lot of notes payable, they're going to be having a big interest expense. So you'll be able to compare, right, your company's interest expense. It should be on the income statement. And that would make them particularly vulnerable to an interest rate change. Maybe, unless they have bonds, fixed rate, maybe not. It just depends what is going on there. Do they have unrealistic incentive programs in place, right? Are they encouraging very aggressive sales tactics? Like Wells Fargo comes to mind, right? Those people start making up fake accounts. Imminent bankruptcy. So is this not actually a going concern? Right? Accounting is based on the assumption that the organization is a going concern, things won't be liquidated. So if they are, that they would have incentive to fake the financial statements. Will something happen in the future if they have poor financial results? Will some deal not go through? Will something fail? Will some contract not be awarded? If something like that is in the future that depends on good financial statements, then obviously there's the risk they're going to commit financial statement fraud. In an organization where management, these are smaller companies now, but if management has the potential to lose their own money, right, a family-owned company, they're going to have strong incentive to commit financial statement fraud. All right. And does they continue? Are they continuing on a crisis? Right? Is there good planning and budgeting? I mean, or is there always something going on that we're having to work around? Do they have difficulty collecting receivables or cash flow problems? Again, looking at the cash flow statement, looking at the accounts receivable balances. Do they seem reasonable? Do they depend on a couple of products or services? Right? So if they have something that could become obsolete, that would be a high risk factor. Do they have just one vendor? Like thinking about trade issues. If something happened, would they still be able to continue if they couldn't get something from this one supplier? Are the footnotes explanatory? Are there proper disclosures made in the footnotes? Because not just the financial statements, not just that income statement, balance sheet, and cash flow statement, there's not all you want to look at. There are a lot of footnotes that explain how they came up with those numbers, and you want to read those. Is there anything suspicious? And are they consistent with non-financial performance indicators? So if revenues are going up, but sales are going down, right? They're closing stores, but revenues are somehow going up. Does that make sense? Right? These are things you can find in the management discussion and analysis. Oh, we've closed these stores, but our revenues went up. What? How did that work? Right? So you can look at these non-financial performance measures and say, does that make sense with what they're telling me in the financial statements? Right? So it's all about, do they make sense? And that's what we tend to learn in our finance classes and our accounting classes as we read those financial statements. Are they making sense? That's why it's important to know how they get put together so you can know if it makes sense. All right, so that ends chapter 11, and I hope you have a great time working on those quizzes and cases.